I think one stock can change lives. I do not say that lightly. I also do not say it because I enjoy dramatic language. Most dramatic language in markets is camouflage for weak thinking. But every so often you come across a situation where the gap between business reality and stock price reality gets so wide that even a cautious man has to stop, look twice, and ask whether the market has temporarily lost its mind. That is what I think has happened here. This stock is down roughly 83% from recent highs at the exact same time. Paid subscriptions are still growing meaningfully. At the exact same time, the company is keeping almost 90 cents of every revenue dollar after direct costs at the exact same time. It is landing larger enterprise contracts and embedding itself more deeply into customer workflows. That combination matters when a business is deteriorating and the stock collapses. That is not interesting. When the stock collapses while the business keeps proving itself, that is where my attention starts to sharpen. The market likes to tell one simple story at a time. Right now, the simple story it wants to tell is that software is broken. AI has destroyed the whole business model, and every software as a service company deserves to trade like a slowly sinking ship. I do not think that story survives close inspection. That is why I want to walk through it carefully. Because there is a difference between a real disruption and an indiscriminate liquidation. There is a difference between a sector getting repriced and a sector getting mispriced. And when those two get confused, money changes hands from emotional sellers to patient buyers. That is the first rule. The market does not pay you for agreeing with the crowd after the dust settles. It pays you for being rational while the crowd is still throwing furniture. Now let us start with a broader context, because without that, the opportunity in this one stock just looks like a cheap chart. It is more than that. 2026 has been brutal for software. The broad software ETF is down sharply from its highs. Billions upon billions, actually trillions, in market value have been taken out of the sector. Oracle got hit, Microsoft got hit, Figma got hit, Duolingo got hit, DocuSign got hit, HubSpot got hit, Monday got hit, Salesforce got hit, Adobe got hit. The names are different, the severity varies, but the pattern is the same. Investors looked at software and decided they no longer wanted nuance, they wanted escape. That kind of selling is usually driven less by precise evaluation than by a desire to get exposure down quickly. Once that mood takes hold, the market starts treating unlike things as though they are identical. Quality gets sold with junk, profitability gets sold with hope, real moats get sold with PowerPoint fantasies. That is exactly when you can start finding the sort of mispricing that changes outcomes for disciplined investors. Now, why did this happen? Why did the market suddenly decide that software, one of the most productive and profitable sectors in modern business, should be treated like a melting ice cube? The spark was AI. More specifically, the fear that AI agents are about to do the actual jobs the software companies were charging for. When Anthropic dropped its cowork product, Wall Street saw something terrifying in the abstract. The theory was straightforward enough. If AI agents can do the work that used to require multiple software seats, then companies will need fewer licenses. Fewer seats means lower subscription revenue. Lower subscription revenue means the whole SaaS model starts to unravel. On the surface, that story sounds intelligent. That is why so many people believed it. But when a story sounds intelligent too quickly, I like to ask what work it is skipping. In this case, it is skipping almost all of the hard work. That is the second rule. In technology, people always overestimate how quickly the demo becomes the system. Yes, AI can help build the beta version of a software product astonishingly fast. It can draft interfaces, it can connect basic workflows, it can mimic functionality that used to take a team months. That part is real. Anybody paying attention can see it. Building the first 2% of a software product is becoming radically easier. But investors made a very sloppy jump from there. They assumed easier creation of the first 2% means the remaining 98% is suddenly worthless. That is nonsense. The remaining 98% is the actual business. The integrations, the compliance layers, the security, the access controls, the reliability, the enterprise permissions, the audit history, the uptime expectations, the support infrastructure, the edge cases, the ability to plug into how a real business actually operates without breaking something mission critical on a Tuesday afternoon. That is the hard part. That is the sticky part. That is the monetizable part. Anybody can now build something that looks like a CRM in a short demo. That does not mean they replace Salesforce. Anybody can build a slick interface that mimics project tracking. That does not mean they replace the system. An enterprise actually trusts across departments, approvals, reporting lines, automations, APIs, and compliance reviews. This is where markets get into trouble. They confuse feature risk with business extinction, and once that confusion spreads, prices detach from what good businesses actually do. The funniest thing about this whole panic is that while Wall Street was telling everybody software was dead, the actual customers did not behave like software was dead. The customers did not run. That matters more than almost anything else in this whole discussion. If software were truly being destroyed in the way people claimed, you would expect one thing to happen quickly. Renewals would collapse, retention would deteriorate, seats would vanish, budgets would get slashed, the whole category would start leaking demand. That is not what the data has been saying. Gross retention across the sector has remained around 90%. That means the customers are still there, they are still renewing, they are still paying. The market is screaming existential collapse while the businesses are still collecting checks. I do not ignore that contradiction. I lean into it because contradictions like that are where opportunity begins. Now, I want to be fair. I am not arguing that AI changes nothing. It changes a great deal. I do think software pricing models will evolve. I do think some companies are going to lose their edge. I do think a few names are living off narratives that will not survive a real transition. That is all true. But a change in pricing architecture is not the same thing as the death of software. A change in how value is delivered is not the same thing as the elimination of value. And when the market acts as though every software company is headed to zero because one part of the stack is getting disrupted, that is when smart investors should stop listening to the shouting and start reading the numbers. So let us do that. The forward earnings multiple on software has collapsed. What used to trade at absurd premiums now trades closer to the market, and in some cases below the market. That is remarkable when you remember what sort of economics many of these businesses still enjoy: high gross margins, recurring revenue, multi-year relationships, embedded workflows, expanding product suites, cash flow, low capital intensity. That is not a dying category profile. That is a repriced category profile. There is a huge difference. And once a sector with those characteristics gets repriced too far, the upside can become extraordinary, because all the market has to do is move from disaster assumptions back toward normal assumptions. It does not need a miracle. It only needs people to stop hallucinating a total collapse. That is why respected analysts are using words like generational buy for parts of the space. That is why major research desks are still projecting large, long-term growth in application software. They are not saying nothing changes. They are saying the market has priced in an almost cartoonishly bad version of the future. When that happens, you do not need perfection. You only need reality to be less awful than the panic. Now, I always like history as a sanity check in moments like this, not because history repeats exactly, it never does, but because it humbles the people who insist their fear is unique. Back in 2016, there was another serious SaaS scare. LinkedIn got obliterated in a single day. Tableau got crushed. Salesforce dropped. The whole sector looked radioactive. The narrative at the time was different in wording, but similar in psychology. Growth was over. Spending would slow. Multiples would never come back. The easy money had been made. A new technology or shift in enterprise behavior would destroy the old leaders. People said all the usual things frightened people say. And then what happened? The sector recovered. Microsoft bought LinkedIn. Salesforce went on a long run. The people who sold in disgust got to watch other people build wealth with the same assets they had dumped only months earlier. That is the third rule. When an entire sector gets repriced on fear of technological change, the market almost always throws away more than it should. That does not mean every stock survives. It means the sector level move usually overshoots. And overshooting is where the money gets made. Now let me get even more specific, because this is where I think the lazy version of the software panic really falls apart. People started acting as though the entire sector was full of fake businesses held together by hope. That is absurd. Oracle is not going to zero. Salesforce is not going to zero. Duolingo is not going to zero. ServiceNow is not going to zero. These are not empty shells. These are deeply embedded systems with real customers, real relationships, real infrastructure, real switching costs, and real room to adapt. Could some of them stumble? Of course. Will some adapt faster than others? Absolutely. But the market temporarily quit asking which businesses can pivot and instead asked only which ticker symbols can be sold. That is not analysis, that is evacuation. And evacuation is usually when value starts getting interesting. So now let us come to the stock I care about here, mostmonday.com. I think this may be one of the most misunderstood businesses in the entire market right now. And misunderstood businesses at distressed prices tend to deserve very close attention. Monday built what it calls a work operating system. A work OS, strip away the branding, and the point is very straightforward. It is a highly flexible digital workspace that lets teams organize, track, automate, coordinate, and manage work visually in one place. Instead of having projects, approvals, timelines, communications, CRM tasks, development work, it processes and marketing flows, scattered across spreadsheets, emails, disconnected apps, and internal chaos. Monday tries to consolidate the operational layer. That matters because software with daily workflow relevance behaves differently from software people only use occasionally. The more central a tool becomes to how a team actually functions, the more expensive it becomes to remove. That is where the moat begins. And Monday did not stop at project management. It expanded CRM, sales, software development workflows, its service tools, marketing teams, enterprise collaboration, all built on the same underlying platform structure. That platform approach matters because once a company starts building multiple workflows on top of one operating layer, the decision to switch is no longer a simple substitution. It becomes a migration problem. Migration problems are painful. Painful problems create stickiness. Stickiness creates pricing power and retention. This is one reason I think the market is too casual when it treats Monday like a disposable app. Disposable apps do not keep showing this kind of customer behavior. Now let us look at the numbers because stories are cheap and I prefer numbers. Paid subscriptions have been growing around 27% annually on average in the source framing. That is not a dead business. That is not a category in collapse. That is a business still finding demand even while the sector around it gets treated like it is radioactive. Gross margins are about 89.7%. That is extraordinary, keeping nearly 90 cents of every sales dollar after direct cost gives a company enormous strategic flexibility. It can invest in product, it can invest in distribution, it can invest in AI, it can lower pricing selectively if needed, it can absorb shocks better than lower margin peers, it can fund experiments, it can pivot faster because the economics give management room to move. That kind of gross margin is not a trivial detail. It is one of the clearest signs that the company is selling real software value, not labor disguised as software. And when you combine that with growth, the setup gets more attractive. The company is also easy to integrate into the tools customers already use. That sounds like a boring point, but it is one of the most important things in enterprise software. Great software does not just have to be good on its own. It has to cooperate with the messy stack customers already have. Monday's ability to plug into existing workflows helps customer acquisition pay off faster and helps expansion stick. Then there is the enterprise angle. Monday started with a strong self-serve and mid-market appeal, but it has been moving upmarket aggressively. Bigger enterprise deals matter disproportionately because enterprise customers do not just buy seats, they build internal habits. They create dashboards, they assign teams, they customize workflows, they often build tools on top of the platform itself. Once that happens, switching stops being a purchasing decision and becomes an internal disruption event. That is exactly the sort of pain AI cannot erase overnight. AI can change the interface, it can improve automation, it can replace some manual work. It cannot instantly dissolve 15 different cross-functional dependencies a company built into an operating platform over years. That is why I think the market is underestimating Monday's moat. It is looking at the front end and ignoring the plumbing, and in enterprise software, the plumbing is where the moat usually lives. Now, let us come to the AI question directly, because this is where I think Monday becomes especially interesting. The market's biggest fear is that AI kills software. But what if AI strengthens the companies already sitting inside the workflow? Monday is not pretending AI does not matter. It is leaning into it. Monday Agent Labs, agent building tools, and related internal AI functionality are the beginnings of a different narrative. If software companies can incorporate AI to make their platforms more useful, more automated, more sticky, and more valuable per customer, then AI is not simply an executioner, it becomes an amplifier. That does not mean every software company gets to make that transition successfully. Some will fail. But the companies with high gross margins, strong product surfaces, customer trust, platform flexibility, and enterprise footholds are the exact ones best positioned to try. This is why I think so much of the market's thinking is backwards. It is taking the most adaptable businesses in the category and assuming they will stand still while a technological shift happens around them. That is not how strong management teams behave. That is not how businesses with real economic incentive behave. And that is not how platforms with existing distribution usually behave. Now, I also like the guidance set up here. Management set the bar low. Normally people hear that and think it is a warning. Sometimes it is. But sometimes conservative guidance in the middle of sector panic becomes a gift. It resets expectations. It creates room for beats. It allows the company to walk over a low hurdle quarter after quarter once the mood stabilizes. Markets do not just respond to results. They respond to the relationship between expectations and results. If expectations are buried in the ground, decent execution can look wonderful. That is another part of the setup I think is being missed. Analyst price targets, even after all the damage, still imply meaningful upside in the source framing. I do not worship analyst targets. Most of them are lagging indicators with better formatting. But when the stock has underperformed even bearish framing, it tells you sentiment has become indiscriminate. Indiscriminate selling is how deals appear. Now let me define what I mean by a deal of a lifetime, because that phrase gets abused constantly. A deal of a lifetime is not just a cheap stock. A cheap stock can stay cheap. A deal of a lifetime is the combination of a real business real cash economics, real growth, real survivability, deep negative sentiment, and a market price that assumes a future far worse than the business is likely to experience. That is what catches my eye, and Monday checks a surprising number of those boxes. Real business, real revenue growth, real margin profile, real enterprise traction, real product breadth, real AI optionality, real capacity to expand across multiple software categories without needing any single bet to become a home run. That last point matters. Project management does not have to carry the whole future. CRM can matter, developer tools can matter, service can matter, AI tooling can matter, multiple lines of growth reduce dependency on one perfect outcome. That is how businesses become resilient. And resiliency is exactly what I want when the market is busy pricing fragility. Now, none of this means the stock cannot go lower in the short term. Of course it can. The market has no moral obligation to recognize value immediately. Sometimes it gets more irrational before it gets less irrational. But I do not buy stocks because I know what the next month looks like. I buy them because I think I understand the relationship between price and business quality better than the crowd does in that moment. That is the fourth rule. In great setups, the business is the thesis. The chart is only the invitation. And this invitation is unusually compelling. You have a company that is still growing, still winning customers, still holding remarkable gross margins, still moving upmarket, still broadening use cases, still building into the AI future instead of hiding from it, and the stock has been obliterated because the market decided one fear must apply equally to all software names. I do not think that is true. I think the fear is real. I think the repricing was real. I think the selling got very lazy, and I think lazy selling in real businesses is where life-changing returns can begin. Now, I am not asking anyone to copy me blindly. You should never do that. If you are the one taking the risk, you ought to be the one doing the work. That is non-negotiable. But if you want my honest view, this is exactly the kind of setup I would spend serious time on. Not because it is the hottest thing in the market. It is not because it is safe. Nothing in common stocks is truly safe. And not because it cannot disappoint. It can. I like it because it looks like one of those moments when the market's need for a simple fear story has temporarily overwhelmed its willingness to price a complicated but durable business correctly. Those moments do not last forever. Eventually, the market remembers what it sold. Eventually, the businesses that keep executing separate themselves from the names that only look similar on a bad day, and when that happens, the stocks that were thrown away with the rest of the sector often move first and hardest because the gap between sentiment and reality was wide as there to begin with. That is why I think this stock has the potential to change lives. Not because it is magic, not because I know the future, because when a real business with this kind of margin, traction, platform depth, and optionality gets priced like a casualty instead of a survivor, the odds start to look very unusual. And unusual odds are exactly what I want when I am trying to find extraordinary outcomes. The market can keep shouting if it wants. I would rather keep reading the numbers.